Module Overview. IAS 16. Property, Plant and Equipment (PPE) governs the accounting treatment for tangible fixed assets that an entity holds for use in production supply of goods or services, for rental to others, or for administrative purposes, and that are expected to be used over more than one accounting period. The standard ensures that the cost of these assets is systematically allocated over their useful lives, and that financial statements reflect both asset values and depreciation expenses in a consistent and transparent manner. IAS 16 is foundational in financial reporting because PPE often represents a major portion of a company's total assets and affects profitability, tax obligations, and investment decisions. Scope and key definitions. IAS 16 applies to land and buildings, machinery and equipment, furniture and fixtures, vehicles, leasehold improvements, excluding those governed by IFRS 16. Key terms: carrying amount, the amount at which an asset is recognized after deducting depreciation and impairment losses. Depreciation, the systematic allocation of the depreciable amount over the asset's useful life. Fair value, the price that would be received to sell an asset in an orderly transaction between market participants. Residual value, the estimated amount an entity expects to receive at the end of the asset's useful life. Recognition criteria. An item of PPE shall be recognized as an asset if it is probable that future economic benefits associated with the item will flow to the entity. The cost of the item can be reliably measured. Examples: purchasing a delivery truck for logistics, installing manufacturing machinery. Items that do not meet these criteria are expensed immediately. Initial measurement. Assets are measured at cost at the time of acquisition. Cost includes purchase price, net of discounts, rebates, directly attributable costs, site preparation, delivery, installation, testing, initial estimate of dismantling and restoration costs, if required by law or contract. Cost does not include startup and training costs, general administrative overheads, initial operating losses, costs of relocating staff or facilities. Subsequent measurement. Entities have two options. A. Cost model, default. Carry asset at cost less accumulated depreciation and impairment losses. B. Revaluation model. Carry asset at revalued amount, fair value, less subsequent depreciation and impairment losses. Revaluations must be made regularly. Increases are credited to revaluation surplus (OCI) unless reversing a previous decrease through P&L. Decreases are charged to P&L unless reversing a previous revaluation surplus. Example: a building revalued upward gain goes to revaluation reserve. Revalued downward loss goes to P&L. Depreciation. Depreciation is applied to all PPE except land, usually not depreciated, each component of significant cost value separately. Componentization factors in depreciation. Useful life, economic life, not physical. Residual value. Depreciation method, straight line reducing balance, units of production. Common methods, straight line, same amount each year. Diminishing balance, declining amount each year. Units of production, based on usage. Depreciation begins when the asset is available for use, not necessarily when it is actually used. Derecognition. An asset is derecognized when it is disposed of, or no future economic benefits are expected from its use or disposal. Accounting treatment. Remove asset and accumulated depreciation. Recognize gain or loss in P&L. Example: selling a machine at a price above its carrying amount results in a gain. Major repairs and replacements. Major replacements are capitalized if future benefits are probable and measurable. Replaced parts are derecognized. Regular maintenance is expensed as incurred. Impairment and revaluation. If an asset's carrying amount exceeds its recoverable amount, it must be impaired. IAS 36 applies. Impairment losses go to P&L unless the asset was revalued, in which case reduce revaluation surplus first. Disclosure requirements. Entities must disclose a period. Measurement basis, depreciation methods and useful lives, reconciliation of carrying amount at start and end of period, gross carrying amount and accumulated depreciation, restrictions on title or pledged assets, case study, application of IAS 16, scenario, ABC Lealty acquires a machine for $100,000 with an expected life of 10 years and a residual value of $10,000. The company uses straight-line depreciation. Calculation: depreciable amount equals $100,000 minus $10,000 equals $90,000. Annual depreciation equals $90,000 divided by 10 equals $9,000. After 4 years, the machine is revalued to $85,000. Since the carrying amount at that time is $100,000 minus $36,000 equals $64,000, the revaluation surplus is $21,000, recorded in OCI.